Well, Thursday marks the unofficial start to the third quarter earnings season. Here with what to expect is Randy Frederick, Managing Director of Trading and Derivatives at the Schwab Center for Financial Research. And Randy, it's great to have you back. Welcome.
Great to be with you, Scott.
So we're looking at third quarter earnings seasons. The forecast, at least so far, is looking at about a 5% drop. Now that's including the energy sector, which of course has had a rough year. What's going on here? What should we expect with earnings?
Well, one of the things that's been missing really all year from each earnings report that we've gotten each quarter is the fact that we have about the same number of companies beating the earnings per share targets, roughly 3/4 of them, and about 50% of them beating the revenue targets. But what we really don't have is revenue growth. Part of the reason they keep beating the targets is the targets keep being lowered each quarter. So the expectations for this quarter, not necessarily a whole lot greater than what we saw last quarter, but what we really need to get the economy back on track is we need to see revenue growth. And frankly, I just don't think we're going to see that this quarter.
So that presumably is bad for stocks, at least for the rest of the year. And we keep seeing bank after bank cut their year-end S&P 500 forecasts.
Yeah, I think what you're going to see is for individual stocks, and this is similar again to what we saw for the last couple of quarters, is that individual stocks, even if they beat the earnings targets, if they give cautious guidance, they'll probably get beat up again and the stocks will sell off. And we saw a lot of that in the last quarter. We saw a lot of that in even in the first quarter as well. So if they don't show some sort of optimism going forward for fourth quarter, or at the very least first quarter, we're probably going to see some sell-offs on even those that have good numbers this time.
And you also say that 2015, at least so far, is looking a lot like it did in 2011 in terms of the S&P 500. And of course, 2011 was not a great year.
No, in fact, 2011 finished out with the S&P 500 at exactly the same place it started. So 0 gains, 0 loss. This year we may do a little bit better, and part of the reason we might is because the correction that we had in the S&P in 2011 was 19.8%, so almost into a bear market territory. This year we only got 11, 12%, so it wasn't nearly as dramatic, and we're already seeing a little bit of recovery from that. So yeah, well, I think we'll get back to even for the year, and probably small single-digit gains before the end of the year. Now,
speaking of sell-offs and corrections, October, September is typically the worst time of the year for stocks, at least when you look at the numbers. We had that sell-off back in August, so does that mean we're out of the woods in terms of another slowdown in equity prices for the rest of the year, or is that taking it too far?
Well, you can never say you're completely out of the woods because you never know what might happen. Some completely unexpected event, like maybe we go to war with Russia over Syria. I wouldn't think that that'll happen, but something like that, of course, can derail everything. But certainly, seasonal patterns do show that September has a tendency to be one of the worst months. October, typically the second month, but October, because it's one of the worst months, oftentimes you'll see stocks bottom in October and move higher. But as you mentioned, we had a correction already this year, which was statistically way overdue. We'd gone like 46, 47 months without one, and that's already passed. We've now retested that low just about a week and a half ago. The market's held up. We've had rally 5, 6 out of the last 7 sessions. And so now it does look like we're probably going to hold that low. So I'd say in the near term, it does appear that we are out of the woods, but we certainly can't make that forecast for the remainder of the year. But certainly at the moment, it looks pretty good.
So the playbook until the end of the year is?
Well, until the end of the year, I think we're good right now until about the end of October, until we get past the next Fed meeting. The markets will probably get a little jittery as we approach that date, although I think the statistics and the bond futures would tell you that it's unlikely the Fed's going to raise rates. But then we get to the next phase, which is we've got another impending fiscal cliff that's going to occur on December the 11th, because the budget that they passed on 9/30 only funded the government through 12/11, so we're going to have to deal with that again. So we've got to get past the Fed meeting, then we got to get past the fiscal cliff, and finally, if we can get into the December period, the latter half of December, where the Fed meets again, and we may have potentially an interest rate hike or not, we'll probably be okay. But frankly, it's probably going to be a little volatile and a little rocky here for the next 2.5 months.
All right, Randy, all issues will be following. Randy Frederick from Charles Schwab, thanks very much for coming in.
You're welcome, Scott.
I'm Scott Gamm, and you're watching The Street.